Hello students. Welcome to CAstuff Online Coaching Institute for CA and CMA. Today we will discuss the topic on cost of capital. Meaning of cost of capital. Return expected by the providers of the capital. It means investors in turn expects income on the capital invested. It is also called minimum rate of return. Because firm has to earn minimum this much return to meet cost on its capital.
For example, why do you deposit money in bank?
The answer is you have expected interest on money deposited. Similarly, investors will expect return on their investment, which is going to be cost to the company. Sources of capital include equity, preference, and long-term debt. Equity shareholders are the owners of the company. Preference shareholders will have preference over equity shareholders at the time of dividend distribution and dissolution of the company. Debentures holders will get fixed interest on the face value of debentures. Now, we will discuss how to calculate cost of capital for each of the above. Long-term debt can be procured by way of issuance of debentures or bonds. Irredeemable debentures will not be paid back during the life of the company. These debenture holders are only entitled to receive interest during the life of the debentures. In case of redeemable debentures, company will pay back the value of debentures at the end of maturity period. Company can pay debentures at premium or at discount based on the terms of the issue. If company pays more than the face value of debenture, it is redemption at premium. In other case, it is redemption at discount. If the face value of debenture is 100, and company pays 110, it is called redemption at premium. If the face value of debenture is 100, and company pays 90, it is called redemption at discount. Cost of irredeemable debentures. Cost of irredeemable debenture KD equals annual interest into 1 minus tax rate divided by net proceeds. Please note that interest is to be calculated on the face value of debenture only even though the initial issue was made either at premium or discount. Net proceeds is to be arrived by reducing floating charges from issued price. What is the logic of this formulae? If John borrows money of 1000 rupees at 10% interest, then after 1 year John has to repay along with interest of 100 rupees. It means John has to pay 100 rupees as interest on 1000 rupees borrowed, which comes to 10% cost. Why net proceeds to be considered instead of issued price? From the company point of view, company has incurred floating charges like underwriting commission extra at the time of issue of debentures, and therefore, cost to the company is to be calculated on the net proceeds only. Why interest rate minus income tax rate in the formulae? Due to the payment of interest by the company, its profit is coming down and consequently, there is saving in the form of reduction in tax liability, and therefore, while calculating cost of debentures, income tax has to be reduced. Formulae of cost of redeemable debentures is almost similar to cost of irredeemable debentures. In case of irredeemable debentures, there won't be any maturity. It means, debenture holders are entitled to get only interest payment throughout the life of the company, but are not entitled to receive the value of debentures that they have invested. But this not the case with redeemable debentures. These debentures are to be repaid at pre-agreed maturity date, which may be at premium or discount. In case, company is redeeming for premium, then this premium is going to be extra cost to company in addition to interest burden, and therefore, this cost is to be apportioned for the life of the debentures. Thanks for watching our video. Please subscribe to our YouTube channel as well as sign in into our website castuff.in.